All right. All right. Well, welcome. This is our new season of the Investing Discussion Group for those that are new to these programs or have returned from last season. And I am very pleased to welcome Kristen Jacks, our host of this event. Kristen Jacks is a financial educator, author, and the founder of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and Mutual Funds magazine before becoming a writer and speaker. Her most recent book on investing is a lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. All right. Thank you, Kristen.
Thank you. And thanks so much to Greenwich Library for all the great programming. It's really such a treat. And I use a lot of the great programming. So I don't just speak, I'm also on the other side very often, just enjoying everything that you guys do. So thank you. Okay, welcome everybody to the Investing Discussion Group. This is the beginning of season 4. The way we run our seasons is sort of timed more to the school year. So this is our first webinar for the season of 2025-26. And just like the last seasons, we are going to cover the most popular topics that you guys like. You seem to love anything with like psychology and investing, anything with tax savings, looking at macroeconomics and how that impacts investing. You guys really love to drill down into different investments, especially bonds. That's always a big one. At some point, we will tackle cryptocurrencies. So that'll be a little scary for me, but I'm promised to do my best. And also, we're really going to get into alternative investing this time around. We haven't done that before, but it can't be ignored. One of the big trends in finance is supposedly this democratization of alternatives. And if you don't even know what I mean by alternatives, I mean like private equity, private credit, secondaries, all this stuff supposedly is coming to your portfolio because it will be accessible, it will be affordable, and supposedly it will be better than the stocks and bonds that you can currently buy. So anyway, we're really looking forward to season 4, and let's get started. So, actually, one thing though, because we do have the previous seasons on YouTube, almost all of the webinars are filmed. I mean, every now and then there's a glitch or something gets forgotten, but almost all the past episodes live on the library's YouTube channel, which is very easy to find. So you go to YouTube and then in the search bar, just put in Greenwich Library. And yeah, hopefully you can see in this elongated rectangle, you see the Greenwich Library website, which is like a green open book with the outline of a tree, a white tree on the inside. So if you were to click on that, it would then take you to all the library videos. And you can, a lot of these past webinars are actually kind of timeless in the advice, right? Because we don't really just do like a play-by-play of the current market. We really do more like teaching, really deep principles and things like that. So if you're interested in asset allocation, tax efficiency, bonds, things like that, you can always go back and look at previous episodes. And you can even tell which ones were the really popular ones, like The Psychology of Money, Morgan Housel's book. That was one of our most popular. So that's a great one. We did a terrific one on investing in all different kinds of real estate. So it's definitely worth checking out. Okay, but tonight we're gonna do navigating higher interest rates. We're in the higher for longer environment. And then planning ahead, we will have our next webinar, October 30th, is all about tax efficiency. So that's a big one. And then in November, we're going to tackle psychology and investing. It's not going to be specifically Morgan Housel's book, which is called The Psychology of Investing, but it's really going to get into all the known well-researched cognitive biases that kind of trip us up. So that hopefully if you know that you have like, for example, like a home country bias, or you know about the Dunning-Kruger effect, which is a really interesting one. The Dunning-Kruger effect is like when you have a little bit of competence, you're actually in a lot of danger because you're going to overestimate your knowledge. So we'll go into all of these sort of things that can trip us up with our own psychology, our own cognitive biases. So that'll be in November. And then in December, we're going to do the alternative investments. It's the first time we're doing it because supposedly now things like private credit, private equity, secondaries, all those things are going to be accessible. It's kind of exciting, but we're gonna look at it with somewhat of a skeptical eye too, because we want to make sure that we're not pushing things that are maybe like not so, they're kind of esoteric, they're not transparent, maybe they have too many fees. So we're going to tackle alternatives not with a rah-rah attitude, but with like a real sense of like, could this truly is this really available to you now? Is it really affordable? And will you really benefit if you participate? Okay, so we've got navigating higher interest rates for tonight. This is the higher for longer environment. And what are we going to do about it? So obviously, it's a huge topic, and there are a lot of investments out there. There are a lot of considerations with the macro environment, what's going on with inflation and things like that. So how are we going to really just be tightly focused in a way that helps you guys the most? So I thought about this a lot, poured over everything, and I've kind of put together about 30 slides and 55 minutes. I think this is what we need to tackle. We need to look at how the past 10 years got us here, what was going on in the past 10 years, and how did that set us up for tonight? And then once we understand that setup, then we're going to really drill down into like reviewing and lowering the risk that might have crept into your portfolio because of what the last 10 years offered. And then we're going to talk about dividend stocks also, because if you were trying to, grab some kind of yield in a lower yield environment, you might have started getting really into dividend stocks that where the dividend could be a little bit risky. So we're going to talk about that. And then I'm going to talk again about the alternatives and what's coming, because that's, because of this higher interest rate environment that is also accompanied by inflation, but also accompanied by very, very high current stock valuations. You're hearing all the time now that alternatives have to be considered, and they are kind of coming to you in a way that you can take advantage of them. And of course, we're going to have question and answer. And also, because this is the discussion group, I know it seems like I'm just kind of giving this monologue, but it's really not meant to be that way. Before COVID, so many things at the library were like happening in person, and it was just seemed like more obvious to like raise your hand or anything. So you can always put something in the chat. I'll pause. I try to remember to look at the chat, but if you have any questions or you want to participate or you want to give a comment, I mean, there's so many smart people in Greenwich. Very often you might know something that would be really beneficial for everybody to know. So please contribute. Okay. Quick disclaimer, because we're going to talk about very specific investments. This webinar is for educational purposes only. It is not intended to provide investment advice. The investments and investing strategies mentioned in this discussion may not be suitable for your situation, and all investing involves risk. So before making financial decisions, you are urged to consult a wide range of professionals like tax expert, lawyer, financial advisor, these professionals who are aware of your unique needs and situation. Okay, so actually we have 50 minutes now, not 55, but let's get started. So how did the past 10 years encourage greater risk taking? So like what's been going on for the past 10 years that set us up for this moment in time? So I'm going to explain to you what you're looking at here. It's very important. So it's really important to sort of zero in on the blue squiggle and the red information about inflation, right? So if you look all the way to your left, so the blue squiggle is the yield of the risk-free, what's considered the risk-free, because it's from the US government, the 10-year note, right? So when the government borrows money from anybody for a 10-year term, I don't want to say duration, one very interesting thing about bonds is that duration is not term. So I'm always catching myself and not saying duration. Duration is sensitivity to interest rate changes, and term is actual the length of the borrowing time. So what you're looking at, this blue squiggle, that's the yield on the 10-year note, right? So starting in 2015, so we're going to be back 10 years, what were you getting if you were to loan the government money for 10 years? What was your guaranteed yield from the government? And it wasn't great, right? I mean, if you look, hopefully you can see on the slide where it says like, it has the vertical word percent, and then you can kind of see the blue squiggle starts between the 2 and the 3, right? So you're looking at that if you were offering your money to the government, if you were lending the government money for 10 years, locking up your money for 10 years, the government was giving you 2.5%, but then it dips down. Now it dips down. That doesn't mean that like if you bought in at 2.5%, your rate didn't change, right? So what this is showing you is like as new issues came out, as new bonds came out, this was the yield that was being offered. So at the beginning of 2015, you could get in at about 2.5%. At some points in 2015, you couldn't even get 2%, right? So if you're trying to get yield and you're willing to have your money tied up for 10 years, you're not even getting 2%, right? And this persisted, right? So we see that happening in 2015. We see it in 2016. A little bit of an uptick in 2017, a little bit of a relief, but then it kind of fades, right? So here are all these investors at that time willing to commit their money and they're not getting any yield, right? Now, in the beginning, inflation was low. So, with that low yield, at least you were maintaining your purchasing power because inflation was low. But then you notice that as, the yields kind of tick up, so does inflation. So there's nominal return and real return. So the nominal return is the like just actual return of, taking that yield and multiplying it by your principal. But then there's the underlying, fact that if inflation is, destroying your purchasing power, your real rate of return is not improving, even as the rates went up, in 2018, there was like, you would think this would be some relief. Now you're getting to 3%, but then inflation is spiking at exactly the same time. So really you're going sideways with purchasing power. So this is all to say, and then of course it gets worse and worse, right? Then COVID comes and now you've got, a 10-year note paying less than 1%, right? So someone's willing to tie up their money, give it to the government, and they're not even going to make a 1% yield. So, and the whole thing was just a disaster, right? So I'm showing you this as the setup of like this ushered in a time where people need to make money on their money, right? They have goals. They want to retire. They want to put their kids into college. They need to make money on their money, right? I mean, the point of retirement is not just you save up all the money and you don't make any money on your money and then there's enough for retirement. I mean, if you don't have any growth ahead of inflation, then you're really in trouble. So investors are looking around and they're looking at this dismal situation and they're saying, I need something different, right? So the bottom line, hopefully this is making sense to you, is what we've had for the last 10 years is like you can't use the risk-free rate, right? So there's no risk-free rate way to generate like real returns because any increase in the yield was just like eliminated by inflation. So people are desperate. I mean, there's this term jonesing. You'd hear that they were jonesing for yield. I think that's actually like a drug term or something, like when you have like a craving. But people are jonesing for yield and they cannot get it. They cannot get it in a risk-free way. So certain things started to happen. In the past 10 years, greater risk taking. Number one, exposure to stocks, right? So, as your portfolio matures, as people age, they're supposed to be much more careful about not being so heavily into stocks. But people didn't do that because they said, I can't have like a 60-40 portfolio, right? I can't rely on bonds. So I'm going to have to stick with stocks. But they comforted themselves with the idea. So this is from Investopedia, right? Which is a great website, by the way. So, when people talk about the market and being in stocks, they're often referring to the performance of the S&P 500. And since 1957, this benchmark index has delivered an average annual return of over 10%, a figure that has created substantial gains for long-term investors. However, that number tells only part of the story. And boy, is that true. And that's what we're going to talk about tonight, because people kind of got complacent and they're like, well, I can't get yield. I have to stay in the stock market. I can't have like a balanced portfolio of stocks and bonds because I really need the yield. And hey, I know that, maybe not in the short term, stocks are unpredictable and it's a bumpy ride, but, in the long term, I'm in this for the long term. So, like over a 10-year period, my average return will be 10% each year, right? That's this common accepted wisdom that even though the market may go up and down, overall, you're making basically 10% a year if you give yourself a 10-year time horizon. We're really going to look at that tonight because that's definitely changed. So people did that, right? I've got to do that. I've got to be more into stocks than is normally recommended or comfortable. So that was one consequence of the past 10 years. Another consequence of the past 10 years was this greater risk taking into high yield bonds, right? So you wouldn't just go into the normal risk-free bonds, you would go into the high yield bonds. Well, everybody likes the sound of high yield, right? And so to give you an example, like here, so high yield, why is it high yield? Well, because it's riskier, right? So the high yield bonds are the bonds that are not investment grade, right? So we're going to get into the bond ratings here. But I thought this was so interesting because so that you just believe me that like even like staid conservative institutions were being very, yeah, like they were wandering into junk bonds. Here's like the State of Wisconsin Investment Board. What is that? State of Wisconsin Investment Board runs the pension fund, for all the employees of the state of Wisconsin. This is supposed to be a very, very conservative organization because they have to come up with the money for pensions. And it's really interesting that they share this information. Their portfolio is 26% bonds. And of that portfolio, they break down the credit quality. And so, here you have these high yield bonds. High yield basically means junk bonds. Junk bonds are bonds that are less than investment grade. So these are not the blue chip companies, right? This is not Apple issuing a bond, right? This is like Caesar's Casino issuing a bond and people buying it. So that's what if you're looking at where that arrow is pointing, it's pointing at, once you get under BBB, that's below investment grade once you go under that. And so 15% of the portfolio is speculative. 15% of the portfolio is junk bonds. So that's another thing that happened in the last 10 years where people were chasing yield. So here, just I want to make sure you know what I mean. So this graphic is, this junk bond graphic. What they're saying is, if you understand bond ratings, and there are different bond rating agencies, and they have slightly different scores, right? So you've got like the two capital Bs versus the BA or the BAA and things like that. But what you have to know is, a B is not good in bonds, right? Like if your kid gets a B in AP Calculus, maybe you're feeling good. You do not want to feel good about a B in bonds. A B in bonds is bad. A single B in bonds is bad. So here you are with these high yield bonds that are junk bonds, right? So actually, if you want, you can read through these, like here's the investment grade, the AAA, the AA, the single A, the BBB, that's still okay, right? That's still investment grade. But when you start getting to the double B, and I find this kind of confusing, right? Because if you're not familiar with it, nobody looking at a double B would be like, oh, ooh, that's scary, right? Double B seems kind of good, two Bs. What no, what's wrong with that? Or a single B, but no, it's not good, right? This is not your kid's calculus class. So if you really drill down and you read the descriptions, so here, if you just have a single B, what it's saying is, those bonds, those companies are more vulnerable to adverse business, financial, and economic conditions, but currently have the capacity to meet financial commitments. Okay, do you really want to do like a 10-year bond because the company can currently meet their financial condition, like can currently meet their obligations? Or do you want to buy a bond with a company that if there is a recession, right? If there, God forbid, is another COVID, if there's some like macro event that's no one's thinking about, that they're fine, right? That they have like a 2-year cushion or something. That's what you would want. Well, you're not getting that because it only has a B rating. If you want that, then you have to go back to investment grade. So this is kind of scary that these high yield bonds, I mean, a B is not good. And by the way, take one of the most popular high yield bond funds from Vanguard, right? They're even worse. So the state of Wisconsin, they're only letting themselves do like 15% of high yield bonds. Well, if you go into these high yield bond funds, and a lot of people do, that, you're now have that B, that single B rating is like 35% of the fund. I mean, that's huge. I mean, it's very, very low grade, these high yield bond funds. And by the way, the yield is only 6.23%. So why is all this risk being taken? It's really jarring. But this is the current yield. But if you go back to when you could only make 1%, 1.5%, 2% on the 10-year, people were flooding into these high yield mutual funds, high yield ETFs, because they just felt like they had to, right? Okay, so, oh, okay. So I think that's the setup. I just want you to understand there was like this creep away from safety, right? The last 10 years, you had this creep away from safety. You had heavy weight into stocks. This is for most people. And you had this creep into the lower grade bonds, right? Because how else people were chasing yield? They had to get yield. And then heaven forbid, some people were really like getting into crypto when they knew nothing about it. They were getting into the meme stocks. And this is just, the terrible stuff when people just blindly chase returns, right? So they just hear in the news that Bitcoin has gone up and they pile in. And David Swensen, who ran the Yale Endowment, who kind of really just transformed investing, I mean, he would have been horrified. He just, this chasing returns to him is like the worst thing you could ever possibly do. So this is, welcome to the last 10 years. Okay, so because that's the setup, right? So you have the last 10 years, you couldn't get the yield, inflation was going to eat up everything. Well, okay, so I want to obviously, I'm going to try to convince you that now is the time to review and lower your risk, right? Well, so why am I saying that? Okay, well, if we go back to this chart and you look all the way, to the right to the current, situation, it looks like I think we should really try to think positively that we are going to have the higher yields and they're going to beat inflation. So the risk-free rate is not such a terrible waste of time, right? But also, even if the risk-free rate is only giving you like a 1.5, 2% real return, because the last 10 years have been so dismal, there's been so much creep, right? So much creep and like too much, too heavy on stocks, so much creep, too much high yield, too much junk in people's portfolios. So even if you don't think this is the greatest time to sort of go more risk-free, hopefully I can convince you it's at least time to go and see how much of your portfolio kind of got messed up. It's really just honestly too risky. Okay, and so review. So then what we're going to talk about is review and lower your risk, trim stocks, check bond ratings, and embrace treasury inflation protected securities. All right. Okay. I know it's very hard to make the case for trimming stocks. Everybody loves the stock market and everybody says, I have to stay in the stock market because it returns the 10%, over time. Well, if you listen to the news, if you listen to financial podcasts like I do on my walks every day, that's not the expectation. So if you listen carefully, because of the exceedingly high level of the stock market right now, the really smart guys go out there and they look at, the PE ratios, the price to earnings ratio. They look at how incredibly high, the high value of stocks, right? And they say, when stocks are this high, and we look back in history, when they get this out of whack, what is the forward 10-year return? Okay. And I've listened to a bunch of these podcasts now. And the worst case scenario I've heard is that you would have an average return of -1% real over the next 10 years, right? So forget this 10%. That whole like people are very comfortable with that. If I'm in stocks, then in the long run, the average, I'm going to make 10%. That is not what the experts are saying. And then even sort of the best case scenario at these super, super lofty levels, that, whatever, your stock portfolio is now, the stocks that you have in there in the aggregate, they are going to give you a 3% return. So this is called, this is talking about the general market, right? If you have a very unique portfolio or you are a value investor and you've very carefully picked stocks that are like out of favor and also offer a dividend, that's not what we're talking about. But if you're just in the general market, the S&P 500, the forecast is grim. It's grim. So why on earth take all the risk, right? When it's not because you're going to get the 10%. I mean, maybe you will, and strange things happen all the time. But the experts are saying when they look back in history, when stocks have been this overvalued, and they look at what happened starting from that point for the next 10 years, you got very, very, very poor returns. So at these lofty levels, the outlook for stocks is between -1% to 3% annual return over the next 10 years. Okay, so I hope you take this seriously because I'm like a risk. I'm, this is my masterclass on risk, really. I am so, so worried about people not taking this seriously. I'm going to pause 1 second, just look in the chat. Oh, we do have something in the chat. Let's see. What do we have in the chat? I don't know. Message. It doesn't seem like we have anything in the chat. Okay. One new. Why can't I can't actually see it. Huh. I don't know. Siobhan, are you able to see it?
I can see this. Well, so the first one was me posting the link to the next session for people to sign up, but someone did just add into the chat, what about international stocks?
Oh, oh my gosh. That person is so smart. Well, look at the next slide. Look at the next slide. That's the exception, right? Yes, right. Remember, we don't have home country bias. We are not locked into the cognitive bias. We are smart. That person who made that comment is very, very, very smart, right? So it's our stock market that is wildly overheated. And so if you continue to listen to all these pundits and they're like, hey, we know you're not going to want to do this because people always look to like the more recent past and they say, no, you're not going to convince me to go into foreign stocks because the US is always beating them. Well, I don't know where they're getting that information because this is a really, really interesting chart. Back when, yeah, the US stocks would do okay, but maybe like the Austrian stock market did better, right? Or you know, the like the stock market of Norway or Japan or I really like Ireland. I'm kind of into Ireland. Israel, I know it's very, very dicey times in Israel, but there's all this evidence that there's plenty of money to be made outside of the US, especially now. So, and maybe the US will continue to beat the pants off of other countries. I mean, I think right now this year, the foreign stocks have really performed well, and people are kind of maybe having a little more hope. But they are definitely, definitely worth a look. And so, yes, so thank you, brilliant person. That's my one exception of like, please trim your stocks. But however, if you're going to go into international stocks, then that's a solution. Okay, was there another? Did something else happen in the chat? Okay, I think that's good. All right, so next. Okay, obviously, I'm concerned about everyone's exposure to high yield bonds. And what's so interesting, this is a brochure from an actual 401k plan. And someone gets a new job and then they get this menu and this is what you can participate in your 401k. And so, a very nice person shared this with me, and I've been sharing it with others ever since because I was so shocked. Look at the top arrow. It's like conservative is over here and aggressive is over there. And you look, and the high yield bond fund is considered conservative. That is complete garbage, right? This is this myth that bonds are safe, just universally safe, like bonds are safe, all bonds are safe. That myth drives me bananas. Some bonds are safe. Some bonds are very risky. That's why we have bond rating agencies, right? That's why bonds get graded, right? I mean, of course not all bonds are safe. I mean, that's why they're called junk bonds, right? I mean, if you have investment grade, if you have AAA, that's safe, barring some unforeseen catastrophe. But high yield, from the very beginning, high yield is not conservative. So maybe you don't even know that you ventured into risky territory because you yourself got one of these brochures from your broker and you thought you were selecting very carefully. So please, please go back and look at what you own, right? And maybe you don't even know because if you have like an ETF, right? And it just like it's the angel ETF. Well, that ETF is like the fallen angel ETF. That's the one that's like, well, these used to be investment grade bonds and then they fell, their ratings fell. And even though you still have this nice title like angel, those are junk bonds. So I'm really imploring you, like, look at your exposure to US stocks and trim. Maybe, venture into international. That would be really smart. Look at your exposure to bonds and what is the credit quality of the bonds that you hold. And you might be surprised that you are actually holding high yield, i.e., junk bonds, right? You want investment grade bonds. Okay. And then one thing I'd really like you to consider is that you might want tips, right? So Treasury inflation protected securities, right? I mean, I don't understand. Like, why doesn't everybody love these? So I understand it's not the greatest yield in the world. But if what you're worried about is inflation making you look like a fool, right? Because you finally got like a 4%, 4.5% yield, but then inflation spikes, right? Because we did have that like the terrible, terrible inflation spikes. So actually, I want to go back to that chart because some people might be wondering where I'm getting these numbers. Okay, so here in like between the 2021 and 2022, it's like, well, what does she mean? There was inflation between 1 and 9%. So what I meant by that is the CPI, the Consumer Price Index, so that's looking at like real inflation, right? So it's like a basket of things, right? It's groceries and rents and energy and all these things. It's like the Consumer Price Index, I'm looking at it month to month, right? So if you're in 2021 and 2022, I looked at 24 months, right? And so you had some months that were very close to 1%, but then you had some months that were like 4%, some months that were 6%. And then we had that horrible read in 2022 where it actually got up to 9%. Everybody freaked out. The Fed's raised rates like dramatically several times. So that's what I mean. Like, you don't want to be made a fool, right? You don't want to be buying, even though we finally have these like 4.5, 5% yields. If you're going to have an inflation spike, then, nominally you've made money, but your real return has been negative, right? Because inflation ate up all of your returns. So the great thing about Treasury, okay, so I'll go back to the tips thing so that, and you can find this yourself. This is right on Treasury Direct. Actually, I'm going to check the chat because I think now we have two. Okay, let's see if we have another brilliant comment. What is tax exposure on foreign stock dividends? That is a really good question. Um, so, if you're my understanding, or at least that, so like if you buy like individual stocks, and I think they're called ADRs, like my understanding is that the tax is kind of scooped out and given to the foreign country by your broker or by I've never had to like pay. Maybe I'm bad, maybe I'm delinquent, but that is a really, really good question. So maybe that's I'm going to follow up with that in the next session. I'm going to just do like a 3 minute, like, hey, I followed up on that. And this is exactly how it works because that's a really, really good question. I'm sorry I don't have the full picture right now, but you should definitely, definitely think about that. How do tips mutual funds compare profit-wise to actual tips? So here's the thing about tips. So I mean, I don't love bonds in mutual funds anyway. I just don't like that. One, you're paying like a fee, and two, like remember when like we had like that bond debacle and it was like bonds were going to lose money just because interest rates were going up. That's normal. But it was more like people were panic selling, and then like you're stuck with their panic selling, so you get the negative consequence of their panic selling. So that's something I don't really like. But through your broker, you can figure out, first of all, you can just buy direct on Treasury Direct. So if you've never visited the Treasury Direct website, that's like a really useful thing to do. But also, like, your broker can figure out a way to buy tips for you, but outside of a mutual fund. And I think that's a really good way to go. So I still think, I don't think you want to be lumped in with other people. I think you want to own tips directly through your brokerage. Um, I hope that makes sense. But the one thing you have to be really careful of is, so here, let me introduce tips, and then I'll get into some of the tax consequences. Okay, so the really cool thing about tips is they are adjusted so that no matter what inflation does, you are always beating inflation. So it's an incredible capital preservation tool. So how does this work? Well, it's unusual. So I was talking about the consumer price index earlier. So like every month you can look at what inflation has been doing. If we have to trust some numbers, we're trusting that number. And what would happen is it's not that they change the interest rate. So the interest rate remains the same. So, you put down your principal and you lock in a certain interest rate. But the way tips work is that the principal amount that you put down, let's say it's like $1,000. Say then inflation is pegged at 3%. Your principal amount will be changed to $1,030. And then your interest will be applied to that principal. And it's really, really cool. And so it keeps getting adjusted to factor in the current rate of inflation. And at the end of the maturity time, when you go to get your principal back, you will get, if there has been, inflation upward, you will get a higher principal amount than the amount that you put in. It's pretty fascinating. So it's a pure protection against inflation. Something that I think, everybody should learn more about, everyone should consider, especially in this environment. Now, if there's deflation, your principal amount actually does decrease, right? But there's a monitoring that goes on. So, as inflation bounces around, it's like the principal might shrink and the principal might increase. I'm not expecting deflation, but I guess, over several years, anything could happen. But technically, your principal could go down and then it could go up again. It all just depends on what inflation is doing, but you're really guaranteed to beat inflation. I hope this makes sense. And if it doesn't, I mean, there are just so many if you open a podcast and you put in Treasury inflation protected securities, you're going to get so many, financial experts like explaining exactly what I'm trying to explain. It's definitely worth a look, or talk to your financial advisor or talk to your broker. But I'd like to see this, in your portfolio, like please lower the junk. I mean, if you want to hold on to some triple B bonds and you want to chase a little yield, okay. But let's trim, the S&P 500 type stocks. Let's trim the junky junk stuff. Let's add some Treasury inflation protected securities. I think you will be so much better off. Let me just do a quick check. No, we're good on the chat. Okay. I forgot one thing. This is really odd. So this is an unusual security in that it's actually changing the principal amount. So in the event that, your principal goes up, like we had said, like you started with 1,000, inflation's 3%, now you have $1,030. So in a calendar year, a tax year, you're supposed to pay a tax on that gain. If you owe taxes, in the aggregate, I mean, there's still a standard deduction and all those other things. So that's why they say always try to own your tips in a tax-free, in your IRA, right? Like always try to do it that way so that then you don't have to deal with that hassle, because that's just like it's kind of like just a annoying thing to keep track of. It's not even just paying the tax, it's just kind of an annoying, I mean, that's annoying too, but it's annoying to just keep track of it. So own your tips inside of your IRA is kind of standard advice. Okay. Now, dividend stocks. Okay, I love dividend stocks. Dividends are great. But because of the past 10 years, you might have become, very interested in stocks that seem to be yielding an unusually high dividend, right? But why not? I mean, is when yields are so low, of course, like high dividends are going to catch people's attention. Wait, I'm going to grab this chat. Hold on one second. Uh, ba, 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 ba. Do zero coupon bonds make sense? Are they available? So my understanding of zero coupon, like when you have short-term treasuries, they are zero coupon. So like a short-term treasury might be offering, a 4% yield. But what it means is you just buy like the bond at a discount, like say it's supposed to be like $1,000 bond, and then it's offering the 4%. So you're going to buy it at like the 4% discount. Okay. So wouldn't that be, okay, Kristen, you can do this. Like, so that should be $960. Like say you're buying it for like a year. So you should really only have to pay $960, but then at the end of the term, you're going to get the $1,000. Like that's my understanding of zero coupon bonds. And that's happening all the time because all the short-term treasuries are doing that. I hope I've got this right. So sure, they make sense. I mean, you're getting the yield. You're just getting it at the end of the term. So yeah, why not? Hopefully I have that right. I'm going to check on all these, the tax on the foreign, and refresh my memory of the zero coupon. I've owned zero coupons and that's how it worked, but okay. Now, let's see. Great questions, by the way. Such a good audience. Okay, so dividend stocks. I love dividend stocks, but you can get kind of like lured into something, and if it looks too good to be true, it probably is. So, for example, I really like the company Conagra, right? If I showed you all the different food brands that they have, like the Slim Jim and the Duncan Hines and the Ready Whip um, and Orville Redenbacher popcorn. I mean, Conagra is a great company. They have great brands. They've gotten into some trouble recently, and the stock is way down, uh, which, by the way, makes the yield on their dividend yield look really, really attractive. So who could blame you? If you want to jump on board, there are so many stocks like this right now, like UPS, like Dow Chemical, like Conagra, where you're like, wow, that's a nice yield. And then if you go to a typical stock screen, you're like, huh, I don't get it. Stock's way down, but it has a very low PE ratio. Earnings look okay. What's the problem? So if you only go to a stock screen, you might be like, I'm a genius. I've solved my low yield problem. I'm going to just grab this stock and then enjoy this income stream of this glorious 7.5% yield. Okay, there are a lot of stocks like that. And there are a lot of smart people in the stock market. So if it looks too good to be true, it probably is, and you can't tell from a stock screen. So if you've never gone to the investor relations site of a company, now is your time. You go to the company website, you go to the investor relations section, and you download the annual report, and you download the quarterly reports, and you look at the financial statements, because it's your money and you have to do your due diligence. So I know this looks horrible. This looks like a ton of numbers, but you kind of get used to just looking for things because I'm like, okay, what are their sales, right? Because I'm now suspicious. I'm like, maybe they're not clearing enough money. Maybe they don't have enough profit to pay their dividend, which means they're going to have to lower their dividend. Maybe they have a ton of debt. And so this higher for longer business, well, okay, that's good for me getting my yield on my bonds and stuff. But higher for longer means these companies that went into debt when yields were really low, then when they piled on debt because they're like, why not borrow money? It's only costing us 3% a year. Well, now when they have to re-up because they can't pay off their debt, they have to just go get new debt at these higher rates. Well, now that becomes a huge burden on a company that may already be struggling to make money, right? And why would this be happening with Conagra? Well, food trends come and go, right? So this company loaded up on a whole bunch of companies that, the trend is kind of like away from certain snack foods and things like that. So who knows? Also, tariffs, the cost, just the inflation of like, so that, whatever these companies need in terms of flour and sugar and things like that to make all these ingredients. I mean, they've got a lot of issues or they've got a lot of hurdles. So their profitability is impacted, and now, if they have a lot of debt, servicing that debt, paying, the interest rate on the debt, they can't afford to pay it off. So they have to load up on new debt that has a higher interest rate. So their costs are going up. So this is the kind of stuff where if you look at dividends and they look too good to be true, I really want you to just get in the habit of going in, look at the income statement, look at the balance sheet. So here I am, and I'm like, okay, these guys, they have like, pretty good sales, kind of suspicious when you get to the net income, per share, where you're like, well, okay, they cleared the hurdle this past year, but the year before, I mean, this is a company that's saying that they're paying $1.40, per share in dividends. But just last year, they only made 72 cents a share. So they were going to go, how were they going to pay their dividend? Right. So you kind of see the struggle there and you're like, wow, that's not sustainable. And then you look at their debt situation and you see, oh, wow, they actually have, it's hard to say, do they have a lot of debt? Obviously, everything is relative. Like, is 6 billion a lot of long-term debt? Well, not if you make $30 billion in profit, it's not. So you really have to look at like, what are the sales? What's the profit? And then the debt relative to that. But I'm sensing, especially when I look at, the income statement and I see how expensive it is for them to pay their, so if you look at the line that's interest expense and it's in like the 400 millions, you're like, ooh, 400 million is a lot of interest expense. And it's only going to get worse, right? Because they're going to roll out of their lower yielding, interest rate bonds into having to load up on higher, more expensive bonds because they don't even have the cash to pay down their debt. So this is the kind of stuff that I want you to be like, if you're seeing certain companies struggle, like UPS, like Dow, guaranteed if you go in, they're having some problems with profitability and they have a lot of debt. And that debt is going to become more expensive. And so I'm not saying these companies are going out of business, but so this was several years ago when Conagra had a problem. You see, like they had a really nice dividend, 27 cents, and then boom, it goes to 18 cents. And it stays at 18 cents for the next 2 years, right? So it's not that these companies are going out of business. It's that this delicious yield of 7.5% probably not sustainable. Probably they have to, heaven forbid, suspend their dividend. That's catastrophic, but probably they have to cut the dividend. And when they do, now you'll have a yield of like 4%. And it turns out, like all along, you would have been better off with, a totally risk-free investment, right? Because we're just comparing it to the risk-free rate. Okay, that's a lot. That's a lot to cover. Okay. Let's quickly look at the chat. What do we have here? How can we be assured that any bank or financial institution is FDIC protected? Well, they have to say it, right? Obviously the main ones are. I mean, if you're getting into something online or something esoteric, you got to do your homework. And also always remember that it's only 250,000, right? So, uh, when you're putting money into if you have this problem, it's great, but it's not all of your money is protected. It's the first 250,000, and it should be, the Chases, the Citibanks, the things like that, the Bank of Americas, the M&T Bank, we're not worried about those. But if you're doing anything funky online or anything less familiar, yeah, you got to do your homework because I would be really careful. Also, where can we find a list of interest rates being offered by various banks on CDs or money markets? Okay, I used to work at Kiplinger's Personal Finance magazine, and so that's one of my favorite resources, and I'm sure the library has a subscription to Kiplinger's. Or I don't know if they show it on their website, but every issue of Kiplinger's has like, here are the best rates being offered. And they do something really fun. Like they find things. There are now credit unions. Okay. So I don't know if you know this, but credit unions, those types of, kind of bank equivalent places. It used to be you had to, certain people were allowed to join a credit union. And now like anybody can join the credit union. And some of those rates are fantastic, right? And they are FDIC insured. So yeah, I'm sure a lot of places have to have this. I haven't, I don't know. Does anybody else know? You could put some information in the chat. Like, what's your go-to source to find like the best CD rates and the best money market rates? I just checked Kiplinger's. Money Magazine doesn't exist anymore, but I'm sure the Wall Street Journal has it. So yeah, hopefully that is good. Okay, well, I have to get right in under the wire. Don't miss the December 30th session on alternatives, because this is the big takeaway. If you've been listening to the news, especially with these lofty valuations for stocks, like all the big asset managers are saying, we've got to find a way to offer the regular person these private alternatives, right? And so what do I mean? So, Hamilton Lane did this survey of wealth managers, and they're like, well, what are your clients like? Where are they at? Like, where is their money, right? And it's like the wealthy are in private equity, they're in private credit, private real estate, secondaries, all these things, even venture capital. So that used to be off limits, and now supposedly this is all like the democratization of these things, and it's coming to a broker near you. And so I'm really interested to delve into this. Like Ares Capital Management is a company that does private credit, and they're making it accessible. Like you only need $25,000 to get in, and private credit does have these higher yields, right? So I'm so interested in getting into this. Also, speaking of private, I'm a huge, huge fan of angel investing. And a lot of people don't understand it. Like you might find out that your alma mater, right? So like this is like for people who went to Notre Dame, there are so many schools now where just by virtue of going to the school or being a parent of a student at the school, that you can find out about their private investing, right? So these schools or these kind of angel networks that are associated with the schools, angel investing, they hear about startup companies and they research the heck out of these startup companies and they turn away a ton of. I'm part of one angel network where we look at 40 companies, and then we only let 3 present to the investors. So it's like you're getting all the bad stuff winnowed out. And then you hear about these startups that have really, really great ideas like medical device innovations and all these really cool things. And then you can join like a fund that, so the angel group I'm part of, if you give them $35,000 for the fund, you will get into 8 different investments. And that's a great way to be like exposed to alternatives. I mean, this is private investing, right? This is private equity. So your school might be doing it, your location might be doing it, right? So I'm part of the Angel Investor Forum, which is a Connecticut angel investor network. And these locations are everywhere, right? Like there's a special angel group out in all the Midwest states have them. I mean, it's really interesting. So you could check your college, you could check your hometown if you don't want to be part of the Connecticut. If you hail from Wisconsin, I know they have a really great angel network. And you can just be part of a Zoom call and look at all of these startup companies and be part of a fund that's going to funnel money into different startups. And now, voila, like you're in the alternative space. It's really, really interesting and cool. I think, okay, so I'm just going to check because now we're at Q&A. I'm just going to check the chat, and somehow I got this in with 2 minutes to spare, but this has been really interesting. You guys, great questions. Let's see. Tax on a foreign stock dividend. For some countries, the 1099 year-end tax form would list that. It goes into Schedule 3 of the federal and is deducted from the tax you owe the IRS. Okay. I'm really going to have to look into more of that because feeds to 1040 line 20. Okay. All right. Wait, that's really interesting. Okay, you guys have laid down a challenge. I gotta up my game when it comes to foreign taxes. Yeah, we need a tax expert on this. We need to speed dial a tax expert because boy, so much. Actually, the next session is all about taxes and investing, so this will be perfect. So you guys have to tune in. Let me see one more. Thank you, Kristen. This is very helpful. Oh, you're welcome. Thank you. Okay, and then the actual last slide is join us. Make sure you stick around and join us this fall. So the next one is all about tax efficient investing, and I'm sure as heck going to look into foreign stocks. And then November, psychology and investing, and December, the alternatives. Hope you're there.
All right, wonderful. If there are no more questions, then we'll call it a night. Thank you so much, Kristen. This was
Thank
great.
you.
All right. Take care, everyone. Thanks for joining us.